We're here at the Blockworks Digital Asset Summit on September 14th. So excited to talk to Sue Ennis of Hut 8, a publicly traded Bitcoin mining company. By the way, we are talking just hours before the Ethereum merge. Sue, great to have you here. Can you start by telling us just a little bit about what the Bitcoin mining industry looks like as a business? You know, what are sort of the costs going into it? What are the operational goals? Because I think maybe some people know how a mine works in terms of the cost, but with Bitcoin, it's maybe sounds like this newfangled thing. So what does sort of the industry look like?
Yeah, for sure. So one of the things that really differentiates Bitcoin from the traditional mining space is that Bitcoin miners are incredibly incentivized to find the lowest cost of energy possible. And then they need infrastructure, and then they need equipment, aka miners, to mine Bitcoin. So it's energy and equipment that are the two biggest pieces of a Bitcoin miner's business. And the ultimate goal is to mine Bitcoin at cost. And then so you can ultimately either hang on to it in the hopes and in the plan that it's going to appreciate further, or obviously sell your Bitcoin that you mine for a profit in the market. So that's sort of how Bitcoin mining works.
Yeah, thanks for that. I was listening to a panel with your CEO yesterday, and I think a lot of Bitcoin miners hold on to Bitcoin. A copper miner or a gold miner, typically they sell it immediately. And in the case of some commodities, they actually sell it before it's even mined, by hedging. So how common is the practice of sort of holding on to Bitcoin?
So Hut 8, we have have one of the largest amounts of self-mined Bitcoin of any publicly traded company in the world. Last time we reported, we have a little over 8,100 Bitcoin on our balance sheet. And the reason why you would hang on to Bitcoin is because, do you believe in the value proposition of Bitcoin? So a decentralized, sovereign, non-government controlled currency. And again, you hang on to Bitcoin when you believe in its future appreciation and future asset value. So for example, if you think that Bitcoin does have the potential to capture 2 to 3% of gold's market cap in, let's say a pension plan or an institution's portfolio, that's incredibly accretive to the price. And given that Bitcoin's trading at about 20,000 today, I believe USD, you hang on to it because you believe in the future appreciation of the asset class.
Right.
There's also a tremendous amount of opportunity to actually earn income on top of your stack. So for example, some of the things that Hut 8 has done in the past and that we're still looking at now is looking at, derivatives and call options and option strategies on top of our stack. Also putting that stack to work and earning yield and revenue. Last year, we were earning anywhere from 2 to 4% on about 2,000 of our Bitcoin in a lending program with Genesis and Galaxy. So it's also the ability to build these ancillary lines of fiat-based revenue on top of your stack while you're, looking at sort of the future price potential appreciation. That's some of the reasons for HODL.
For HODL. Yes, I know you joined Hut 8 about 2 years ago.
Yeah.
Walk us through your journey. What did sort of the mining industry look like then? Because I imagine Bitcoin price was way lower and it only marched up higher. And then I imagine mining rigs got only more expensive. So What did that whole take us through sort of maybe the peak in Bitcoin prices in November 2021, so that phase, and then sort of the consolidation phase we've had over the past 9 months or so.
Yeah. So Jamie, our CEO, she took the helm at the beginning of December of 2020 and hired me about a week and a half later. And so that was still very much a bear market. And so we still saw equipment prices anywhere from about the $30 to $40 terahash range. A lot of the competitors or sort of our peers in the space didn't actually even exist. About 16 to 20 publicly traded miners came to market in the 2021 bull market. So it was really there was only a handful of us publicly traded miners at that time. So it was really interesting to see, again, the demand and the appetite for publicly traded miners that then started happening from in about January to about the end of June in 2021. From an institutional perspective, we certainly did not see the amount of institutional participation back then in 2020 that we see now. There was no pension plans in the space. We had a few significant funds that were holders of the Bitcoin miners, but nowhere close to what we're seeing right now. ETF presence was also pretty low, but versus, again, in terms of the structured product that's now available for investors, that has also grown exponentially back from December of 2020. So I think that's what's really exciting about the industry is I've been in the industry since early 2017. So this is technically my second bear market. And it's just so much different if you look at from, sort of who will even take your calls from an institutional perspective or pension plan. We've got bipartisan bills being put forward, the Cynthia Lummis Gillibrand bill, sovereign nation adoption like El Salvador, and the amount of products now that are available from banking institutions like Morgan Stanley, Goldman Sachs, the Valkyries of the world growing their assets and their AUM. So it's been really exciting. Yes, we're still in a bear market, but there's still a ton to be excited about. And the adoption curve still is going up to the right for this asset.
Yeah. And can you tell us a little bit about the sort of, I guess, the rigs? They got really expensive because everyone wanted to mine Bitcoin because the price is very profitable. The rigs price have gone down a little bit. What does the sort of economics look like? I imagine that the profitability of mining Bitcoin is pretty correlated with Bitcoin.
Absolutely.
Like, what is, so how much does it cost? Like, does it ever make sense to make Bitcoin at a loss or no? So like, what does the industry look like now in terms of sort of the unit economics?
Right. So the unit economics obviously are everything when you're looking to mine an asset at cost. So in the spring of 2021, we saw rig prices anywhere from like $90 to $120 per terahash, which is wild. That has now come down to, last time I checked, spot pricing was about $30 a terahash. So that's why it's really important, as a miner, especially, to really take a balance sheet first approach to everything that you do, because this industry, this asset class can move sideways. And if you've paid too much for equipment and the margins that you were initially chasing on Bitcoin mining are no longer there because Bitcoin's back at $20,000 USD, down from 60 or 70, that can really put your balance sheet health at risk because you then have to take write-downs on equipment that is no longer profitable. So unit economics have certainly changed. I think the miners that have the healthiest balance sheet and that took that balance sheet first approach in the bull market, aka weren't paying bull market prices for future orders, are probably going to be doing the best. We also saw like a tremendous amount of debt that miners took on in the bull market. I think we saw anywhere from $2 to $4 billion worth of debt, and miners are now in a position where they do have to sell mined Bitcoin to keep the lights on. But again, those miners who were really cognizant of bull market pricing and just, again, taking that balance sheet first approach to the business in the bull market to set yourselves up for success in the bear market, I think will do the best in the long run.
Having been through multiple bear markets, what would you say are sort of the best practices for Bitcoin miners, crypto miners during a bear market? So that what you said in a bull market, you want to not overpay for things like hash rate, equipment. What are things that Bitcoin miners should be doing in order to really prepare for the next bull market cycle?
For sure. I think certainly looking at, for Hut, for example, one of the things that we really focused on in the bull market, but also in the bear market, are looking at how many different, and I've already mentioned this, ancillary lines of fiat-based revenue can we build out? So how can we diversify our business? So like, let's say Bitcoin went to zero, which we absolutely don't believe it will, but let's say it did. How can we still have a thriving business? So we actually diversified into the high performance computing space, and we're effectively building not only Bitcoin, growing our Bitcoin mining sites, but building hybrid infrastructure models. So hybrid data center models that not only mine digital currency, but also service the underserved Web 2.5, Web 3 space that's really underserved from an infrastructure perspective. So we really focused on diversifying our business outside of just mine and hold on to Bitcoin. And so, I think businesses that really focused on diversifying their businesses, and also just getting really lean and mean. Like, one of the benefits of mining is that it's actually a lot easier to power down a miner than, let's say, to power down a nuclear plant, right? Mm-hmm. So you can actually power down your miners and put them into eco mode if the network's not looking profitable to mine in a matter of 10 minutes. So really staying lean and mean with your operations in, tough times, and also getting creative with how you make other forms of income.
Right. So Sue, I think we're recording either on the last day or the second to last day that Ethereum will be mined as we move on to the Ethereum merge, where it moves from a proof of work model to where it's mined to a proof of stake model. How integral is Ethereum mining to your business now? And how much will that change things once it's no longer is possible to mine Ethereum?
Yeah, so Ethereum mining is not a big part of our business. Last year during the bull market, we did purchase these cutting edge NVIDIA GPUs. It was actually a limited fleet. We were one of 3 customers globally to get our hands on this limited fleet, like the Ferrari of GPUs. And our strategy was to train our team on other iterations of compute. We also knew that we had this hybrid data center model that we wanted to build out. And obviously this is where these GPUs would sit. And also what we did was we effectively mined Ethereum, but then got paid out in Bitcoin. And that was at less than $4,000 Canadian per coin. So we added something like 438 Bitcoin to our stack at that price point, which was great. Obviously, Ethereum is moving to proof of stake. And look, we are fundamentally very bullish on proof of work coins. So we're watching this very close, or proof of work chains. So we're watching this very closely. And certainly these GPUs are built to mine, the next most profitable proof of work coin chain, if that does make sense, like Ethereum Classics, the Raven coins of the world. But look, again, our focus has really been on building out these hybrid infrastructure models to not only mine, but also serve the Web 2.5, the Web 3 space. And so right now we actually just moved 180 of our NVIDIA GPUs from a mining site into the data centers, and they are currently mining Ethereum. We're getting paid out in Bitcoin, but the beauty of these GPUs and the servers that they sit in is that they can also be repurposed to like virtual FX rendering, machine learning, AI. So again, we're watching it very closely, but we've got a ton of optionality, given where things go in the next 24 hours.
Right. Just 24 hours.
Yeah. It happens tonight, I think at 3 a.m.
This is going to be quick. Wow.
Yeah.
But my final question for you is, because a key input to mining profitability is the cost of electricity, I just know that electricity prices and energy prices in Europe have absolutely skyrocketed.
Mm-hmm.
In some cases 10 times, 20 times higher. Are people who mined digital assets in Europe, have they been forced to move to places where there are cheaper electricity, or how big of an impact does it have on the business?
It's a huge impact for sure for miners in Europe. I mean, again, I don't know the nuts and bolts as to what their strategy is for some of our peers that mine out of Europe, but it is a huge headwind for them. Canada is a little more energy independent than Europe. If you look at Canada, so for example, in Alberta, some of the grid pricing is, I think, around 9 cents right now. In Labrador, we're looking at about 3 cents per kilowatt hour. There's a ton of hydro in BC. So Canada, and I would say any sort of energy dependent business in Canada is in a lot better shape than what's happening in Europe. We also sit on a tremendous amount of liquid natural gas reserves, right? Or natural gas reserves. Mm-hmm. So I would say the Canadian business operators are probably in a much better place than our European business operators. But yeah, it certainly remains to be seen how that energy impact is going to be on those miners, especially in the winter. So
yeah, for sure. Well, Sue, thank you so much for joining us. It's been an absolute pleasure.
Thank you so much.